You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back on our same bat time, same bat channel. Yes, it is Education Wednesday. Time once again for Options Bootcamp, the premier options education program coming at you not once, but twice. It is a rare bootcamp doubleheader Wednesday here. Of course, if you want to get all that fun action, you know where to go. We'll get to that in a second. My name, of course, Mark Longo, from theoptionsinsider.com, as well as from the ever educational Options Insider Radio Network. Where do you go to learn more? Well, first off, wherever you get this fine content, make sure you're subscribed to the full network. There's a whole bunch of other great educational content on the network, not just Bootcamp, even though Bootcamp is the tip of the spear. Bootcamp leads the way down the dark side of options education. You also have OPR, Options Playbook Radio, very much the sister show to this one here on the network, hosted by our buddy, Mr. Overby over there. You also have the Strategy Block segment every week there on the Option Block show, where good old Uncle Mike Tussaw from St. Charles Wealth Management breaks down educational concepts and topics. And, of course, we're always fielding questions left, right, and center on just about every other show on the network. So for crypto options or crypto rundown, for the vol market, volatility views, for asset managers and advisors out there, the advisors option, futures options, this week in futures options, you name it. We have a show aimed at it here on the network. So if you're just listening to Bootcamp, you're missing out on all that good stuff. So make sure, A, wherever you're listening, make sure you upgrade to the full network. It's all free out there. It's all available on every platform under the sun. And B, if you like what you hear, don't be afraid to throw a few stars our way. It does help new people continue to discover the network. And then, of course, once you go down the network, you say, you know what, I need even more in my life. We got you covered. TheOptionsInsider.com/pro is the place to go to learn more about all that. You get pro Q&As every week with some of the best minds in the world of options, as well as options oddities every week, as well as nearly 200 episodes for you folks to mainline. That's weeks worth of content now. You just go to the pro feed and just sit there without eating, drinking, without going to the bathroom for over a week, and you can have content nonstop there, as well as, of course, giveaways. We just gave away our pro trading crate. Congrats to, who is it? Stegosaurus, who won it last week, as well as, of course, live access to this, everything else we do here. So if you want to join us and heckle Mr. P like I do here on the show, theoptionsinsider.com/pro is the place to go. Speaking of Mr. P, I am joined once again by the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, what the cool kids call MTM. Mr. P, welcome back to the show, sir.
Hey, Mark. It's great to be back. How's it going with you, my friend?
I am going well, especially when I see folks take the time to leave us ratings and reviews, just like Big_Chungus. that might get my vote for handle of the week, Dan. A Big_Chungus says, 5 stars, Mark, quote, the voice, and quote, Sleepy Dan are the best in the biz. So I get the voice, you get Sleepy. So Big_Chungus, he gets double points from me. I like him already. You can tell he's a very intelligent person.
Oh, you know what? this is where we need some video here, or at least the ability to put out some emojis. So do we got time to go down a little rabbit hole story?
Sure.
Okay, so this past summer, me and my family went to Italy, and our first trip was in Naples, and we're in the Airbnb, and it's late and we're jet lagged, so we're kind of like awake, and we're like, we're out of wine. So me and my son there's like a liquor store across the way, and in typical Italian fashion, in the liquor store, there's, the proprietor and some dude, and, they're sitting there just standing at the counter, sipping some wine, shooting the breeze, it's like midnight, right?
That's early. That's like 5 p.m. for us there in Italy. They're just getting started at midnight.
Right. And so it's like, oh, hey, you should try this. Oh, and so I'm like, all right. So like I try it, and I take my hand, and like I put like imagine if you like pinched all 4 of your fingers and your thumb together, like as tight as you can, and then like face it up. And like, I don't know, I just did that for some reason, just because I was thinking like, oh, what am I going to say? And to me, that was like, oh, like I'm thinking about it. And the guy goes, hey, what are you doing? Why are you doing this? Do you know what this means? And I'm like, no, I don't know what this means. He goes, this means the and so
we'll have to beep that out for the non-explicit tag on all the stores, but by all means continue, sir.
And so I'm like, really? That's what this means, the and so like that's become, just a new little fun family thing that we share. And so I'm making this thing. What are you sleepy? Come on, man. Come on. I'm wide awake over here.
Dan, once again, choosing to work blue as we keep on rolling right on into the basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, everybody, welcome to Basic Training, the portion of the show where we break down some basic options, concept, or technique and explain how you can utilize it in your own portfolio out there. And Dan, you think you can follow along with me? Can you get your mind out of the gutter and of the land of offensive Italian hand gestures?
There are others. There's whole YouTube videos on this, man.
Now, that's a shame it isn't a video podcast, because then folks could see you demonstrating in great detail all of the explicit hand gestures you learned during your last trip to Italy. All right. I digress. We can go down that rabbit hole if we want, listeners. Instead, how about we go down a different rabbit hole? Let's go down the rabbit hole of ratio put spreads, huh? What do you say about that? It's an intriguing topic. I noticed we had a few more listener questions around this topic recently, and it got me thinking. I think I even mentioned it on the last episode. Maybe we need to revisit this in a little bit more detail, because I know the show's been running for a long time, and I know we have new listeners all the freaking time. So some people come in. I know a lot of you, I see the numbers, a lot of you go back to episode 1 and listen all the way through, and we love you all who do that and take the time. Others come in more recently that go back. Maybe they skip around, they look at the titles of the episodes that resonate to them, or maybe are a topic they want to learn more about, and they just go to those. I get it. Time's precious. Everyone's got their own thing at the end of the day. So we haven't talked about ratio put spreads in a while. We talked about ratio call spreads recently, aka the old stock repair, and the pros and cons of that. That was back in October of last year. But Dan, the last time you and I chatted about ratio put spreads was actually a while ago. We got to go back almost 3 years to pretty much the onset of the pandemic, sir. It was April of 2020. We did an episode with that loser, that once and future Dr. Vicks, Mr. Rhodes. I mean, who would want him on an educational show? What a loser that guy is. I mean, come on.
Russell Rhodes, my man.
I saw he just got in a pretty bad, scooter accident. He's pretty banged up. So our well wishes going out to the once and future Dr. Vicks. He is in recovery. That guy's always got something up with him over there. Dang. These days, apparently he took a header off of a scooter. I'm not sure if it's one of those rented scooters you ride about the city. Probably one of those, but yeah, he took looks like a bit of a header. So the last time we had Mr. Rhodes was back on the NASDAQ days on the show here, back in April of 2020. That's the last time we touched on these. So we know we have literally an entirely new audience who's joined the show since then. So a good time to dive back into these. But before I get into some specifics and examples, Dan, let's start there. When you think of ratio put spread, someone comes to you at MTM and says, Mr. P, Mr. Passarelli, and they give you an offensive Italian hand gesture. And then they see that's how you get in the secret club over there at MTM. Then they ask you, what do you think of ratio put spreads? What do you tell them, sir?
I say every option strategy has its place. That's why there's a whole bunch of different strategies, because if there was, just one that was absolutely the best, that would be the only one people trade. They each serve their own purpose. And when the situation arises where a ratio put spread serves the best purpose, then by all means, man, use it and be good at it.
Use it indeed. We got, who is that? Oh, Nichols in the live chat saying, Dan, work in blue. Yeah, he does like to work blue every now and then. That's why we get the explicit tag every once in a while, just solely for Mr. P. No other reason here on the network. I'm kidding. No explicit tag for us. Family friendly all the time here on the network. So you can learn about ratio put spreads with your kids if you are so inclined, or maybe if they are so inclined, if you could tear them away from the TikTok or whatever the heck it is they're using out there these days. TikTok about to be banned, so maybe something else. Maybe going back to Snap. Who knows? Let's get out instead to the land of put spreads and ratio puts. When we're talking ratio put spreads, let me clarify there, listeners, as well. The most common use case in terms of ratio put spreads is going to be the buy one, selling two. So you're buying one at the money, nearer the money put, and then selling two farther out of the money puts against it. You can do it the other way. You can sell one closer to the money and then buy two farther out of the money. It's not the most common use case, though. Usually we see that for calls, and usually that's in products like VIX, because if you're going to sell one and buy two, what you really want is for the underlying to explode in the direction where you're long to. And so puts, just by definition, don't usually have the same room to explode. They are finite. They are capped. They can only go to zero. So not often do you have an explosion to zero. It can happen. Firms can go under, that kind of thing. But normally you have people leaning towards that on the upside, because you have unlimited movement to the upside, or unlimited potential movement to the upside. And in a product like VIX, they are designed to explode to the upside, maybe last year notwithstanding. So we're not going to talk about the sell one, buy two today. We're going to go the other way around. And usually this conversation is done in comparison or contrast to the traditional short put, which is a strategy, of course, we've discussed infinitely on this program and indeed on this network over the years. So we're going to do our comparison the same way. We're going to look at them and compare and contrast them the same way. So you're coming at this strategy, you're looking at XYZ. XYZ is hanging out at $50 right now. And if you look at it, you could say, well, that XYZ 50 put trading at $1 and XYZ 45 put trading at 50 cents. So you might say to yourself, well, I can come out right now and I don't mind buying a little more, maybe down around 45. So I don't mind, let's say, selling, in our example, this is all front month. So selling that front month at the money puts for 50 cents. The pros of that, pretty obvious. You get the income stream. If it doesn't go there, you get to keep your 50 cents. The downside, if it does go there, you're buying the stock at the effective price of $44.50. So that's why we always say the first level of risk management, the first level of due diligence you have to do with any of these downside premium harvesting type strategies is, are you comfortable buying the stock there? If you are, then, case closed. You're good. Now, another way to go is maybe you're looking at that 45 put and maybe something's happening in the near term over this month where maybe you think this stock, maybe you don't fully understand it. Maybe you think another shoe is waiting to drop. For whatever reason, maybe you're a little bit uncomfortable selling the put right at the 45 strike. So you can do a couple of things. You can obviously go down lower to a 42.5 or 40. We don't have those in our example, but they would obviously be lower premium levels there. So maybe those just aren't attractive premium levels to get you out of bed to really want to sell the put. Or you can do what we're going to do in our example here. You can go for the ratio 1/2 put spread instead. So in this example now, I said, remember, the 50 put trading at $1, the 45 put trading at 50 cents. So if you buy the 50 put, now you're buying it at the money put, right? You paid $1 for it. So you need the stock to drop to at least 49 to break even. Very basic math there. But if it does, you're covered 49 and below. You're making money all the way down. So that's a nice thing. Of course, on the downside of it, you just paid 2% of the value of the underlying for a 1 month put. That's a lot. You keep doing that month after month throughout the year, that's really going to drag on your returns. It's going to make it almost impossible to have a positive year in XYZ. So you're going to want to do something against it. And in this case, you look around and say, you know what? I still don't mind buying the stock around the 45 level, maybe a little bit below in this case. Maybe I'll turn around instead and sell 2 of the 45 puts against it. Now, what have you done? You bought 1 put at the 50 strike for $1. You sold 2 puts at the 45 strike for 50 cents. So net premium wise, you are flat. You have no outlay, 0 outlay for this trade. So you might say, well, great. That's a winner. Free put spread on this name, 1 by 2. I love it. What's the downside? What could possibly happen? Well, of course, the downside is your broker doesn't see it that way. Your broker says, well, you're actually short an extra put at this strike. So they're going to margin you as if effectively you had come in and shorted put at 45. So let's walk through what happens to this position in a couple of different scenarios. If XYZ, I should say, stays at 50 or above, nothing happens. You're pretty much flat. You tied up some capital to cover the cost of that extra put, but outside of that opportunity cost, you're not really out anything. Now, if the stock drops to 45, in the first example, if you sold that put just straight up, you would get your 50 cents. And if it, let's say it closed at 45.01, you keep your 50 cents and you live to fight another day. If it closed at 44.99, you're going to get that stock put to you at an effective price of 44.50. So not the end of the world. You said you wanted the stock there anyway. But now let's say we bought 1 and sold 2. Now what happens if the stock drops to 45? Well, let's say it goes 45.01 is where it expires in our example. So those 2 at the money puts, the now at the money puts, the 45 puts that you sold for 50 cents, they go out worthless. The put you bought for $1 is now worth 5. So that's a nice little trade. So the profit potential in that near term is there for this strategy. Now, what happens if the worst case scenario comes to pass? Stock continues dropping through that 45 strike. The thing you were kind of worried about, the thing that made you a little skittish about outright selling that 45 put. Well, that's where the 1 by 2 put spread also comes in to help you. It gives you a little bit of that cushion, gives you a little bit of that wiggle room so that if you do blow through the strike, maybe you never were that convinced that the stock was going to stop there. Maybe you thought it could have had a chance to blow through it, in which case this little bit of cushion is going to help you. Remember I said you made $5 now on that put spread. You have that profit cushion because now you're going to start losing money on that extra put for every tick of the underlying below $45. So what happens is now, instead of effectively having your puts scratch around 44.5, your break even to the downside goes all the way to $40. So if it starts getting below $40, you're going to start losing money on this trade. But if the stock ends up going out, let's say $40.01 on expiration, you missed your window. You overshot by 5 handles on that short put strike. But because you had that long put in your back pocket, it covered you. And so effectively now you're breaking even at that 40 strike. You're still getting that stock, but you're getting it effectively at a much better level there. So that's why people like to do the ratio put spread, because it's for that time where maybe you're a little bit skittish. You need a little bit of wiggle room. Now, how you set them up, this differs. You ask 50 different option traders, they're going to give you 50 different answers. In fact, we just discussed this on our pro Q&A with Uncle Mike earlier this week. We had a question along these lines. Another reason why I started thinking about ratio put spreads, a good thing to revisit here for the show today. But some people will say, I will only do these for a credit. I will only do this ratio put spread if I can buy 1, let's say in our example, for $1 and then sell 2 for 60 cents. So now you made a 20-cent credit. So now you like it. So now in case nothing happens, you actually are pocketing some money. And that makes sense. Maybe you have an underlying where the put skew is very bid. The out of the money put wing is very elevated, in which case this trade makes even more sense. You're taking advantage of elevated skew, in which case this is a great trade to do that. Some people will only do them in those scenarios. Some people will only do them if it's around even money. Some people will do them up to a small debit because they really want that extra little bit of cushion, extra little bit of wiggle room. I tend to fall in that camp of I prefer to do them for even money or a credit. Sometimes if you twist my arm, I can do them for a small debit, but usually I will only do them for flat or for a bit of a credit because I like to do them in scenarios that are favorable to me, which are, of course, those moments where the put skew is extremely elevated. So a number of different reasons why you might want to do this and why you might want to do this in lieu of just selling the put outright. So Dan, when someone comes to you at MTM and they ask you the same question, the same example maybe, let's say XYZ again, hanging at 50. They're like, I might want to sell that 45 put, but maybe I don't know about the 50 cents. Maybe I want more, or maybe it's a case of I'm not quite comfortable, may blow through that a little bit. What do you counsel them in those scenarios? And what do you prefer in that scenario? You like the old selling the put, I just want to get all the juice I can? Or are you more of a ratio put spread guy?
Well, usually when I sell puts, it's part of my investing strategy as opposed to a trade. I will trade short puts sometimes, but usually it's with the intent of, air quotes in a funny voice, I'm okay if I get assigned. But no, I'm seriously okay if I get assigned. In fact, I kind of want to get assigned. So, the put ratio spread, I just look at it personally, I look at it as a completely different thing. And notwithstanding the stuff that you said, I think I'm pretty aligned on, generally speaking, everything you said. But I think a good way to look at it is from the way I look at all my trades and teach our student traders to look at it. Look at it statistically based, edge based, and think of it as, stock prices are log normally distributed. So, you can imagine a bell curve in your head, and then you go into your trading platform and you model it. Like I went into Apple here and I modeled buying 10 of the March 24th, 149 puts, selling 20 of the March 24th, 145 puts, which is pretty close to zero, like a zero debit credit. It's actually a small credit, which I prefer, because if you're wrong to the upside, you're not going to lose. The only risk is to the downside. And if you set this up correctly, clearly you have a bias to the downside, and you have some presumably, smart things that are not guaranteed, but like give you an edge of hopefully having a better chance of being right than wrong. But those bigger moves that kick in, where the losses kick in, if it moves too much to the downside, if set up properly, should be like, a couple sigmas out. It should be a very unlikely event, which is why you'd be willing to take that risk. So think of it that way. First, I've got my technical or fundamental analysis, to be bearish, but what is the likely degree of this move? And at some point, there's just so much support, or it's just such a, it's a multiple standard deviation move that you're like, no, it's highly unlikely it'll go down to this point. It can, but I'm willing to accept that risk. And that's what makes these ratio put spreads pretty special. You can get a pretty highly leveraged return. If you're exactly right, you can get a pretty good return if you are right enough. And if you're drastically wrong, should be fine to the upside, and you just have to worry about the downside. You mind if I throw in one more thought that's not related to that, but I think is important?
Have at it, sir.
So, another thing with these is we talk about returns, and a lot of traders who don't trade a lot of ratios or diagonals or things like that are just used to saying like, hey, I paid 5 for the call, I sell it at 8, boom, there's 60%, very straightforward on what your return is. Or, even if you're good at trading credit spreads, you figured out at some point, or you had somebody explain to you at some point that the best way to calculate that is return on risk, right? Like, what's the most I can lose here? Okay, how much did I make on this? Okay, my return on risk was this. It's a lot trickier when it comes to these spreads, because you could be putting them on as $0 trades or tiny credit trades where, worse if it goes up a lot, maybe you make $40, but if it goes down like right to your perfect strike, you make $4,000, right? So it's pretty hard to have a clever system on measuring return on risk or percentage profit and that kind of thing. So you really have to think about these a little differently.
I think it's fair to say for you, Dan, 9 times out of 10, you're going to come out and you're going to sell the put straight up. You're not going to mess with the ratio. Is that fair?
Yeah, definitely.
And that's totally a fair approach. I know a lot of people who are in that camp. Some people, they're saying, hey, I'm doing this to kind of harvest premium. I want to get the maximum amount. I've done my due diligence. I am truly comfortable buying the underlying at that particular strike. So if that's the case, if that's you, listeners, then there's nothing wrong with just straight up selling the put. That is a very viable strategy. There's a lot of size money out there, big funds and others. They try to use a lot of sophisticated terms to throw at it. But at the end of the day, all they're doing is just selling the put. So you could join a very esteemed club and do naught else but just selling puts all the time, as long as you've done that true due diligence and you are comfortable, truly comfortable picking up the underlying at that level. But if you're not, maybe the put skew is elevated, like I was mentioning before, you could do it for an attractive credit, in which case a ratio put spread could be very attractive. Also, as Dan was mentioning, you kind of get that little bit broader target range. You don't have to hit right at that strike. You buy that put, and now you have more wiggle room in that trade. You have more area where you could potentially make a profit. And if it goes against you, you have more buffer against losing money catastrophically on that trade. So if that attracts you and you find an underlying where the levels make sense, you can do them for reasonably attractive, very low, hopefully debits or potentially even credits, then this might be a strategy that might make sense for you. I'm curious. Let's put it out to you folks now. I know a lot of you have written in asking about ratio put spreads. We've given you our thoughts. I like them. Dan, more of a straight selling the put guy. Again, to each their own. There is no right answer to this question, but I know a lot of you have written in about ratio put spreads. What is your use case for them? Why do you like to use them? Maybe give us an example of an underlying where it worked out for you, a trade where it worked out for you, or maybe a trade where it didn't. If you want to be anonymous on the trade that didn't work out, don't worry. Hey, we're all learning here at the end of the day. We don't slam anybody because your trade didn't work. It's just something that can help teach. Dan and I have had all kinds of trades not work out over our trading years. So we're not going to give you a hard time for it. We're going to use it as a learning moment for everyone involved. So if you have a use case that you prefer, or perhaps you hate this strategy entirely, we've got Options Queen, another one of our pro members listening live right now. She says, I like this strategy, but I only do ratio put spreads for credits. I'm like the Rock Lobster. Yeah, you and the Rock Lobster have that in common. He will only do it for credits. Sounds like you're in that same boat. Again, also a perfectly reasonable approach. If you're going to do this, at the end of the day, you don't want to pay for it. You want to get paid for it. That makes sense. I understand that logic. So if you're in that camp, maybe you want to consider ratio put spreads, listeners, but you want to draw that line where only a decent credit will get you to the dance. Otherwise, you're better off maybe just selling the put or maybe avoiding the trade entirely. So to each their own on this particular strategy. I'm not trying to lure anyone to the dark side. I just want to give you a little bit more familiarity with what we're doing, some of the use cases for it, and maybe some of the pros and cons of adopting this strategy versus its most common comparison, which is just the straight short put. Oh, Dan, we really went on about short puts and ratio put spreads here. So that music means we're already out of time for our first episode. So that was a fun one. But we gotta have time for the second part of our double header. So all of our pro folks, hang out in the live chat. Stay tuned. We'll be back instantaneously with episode 2. Everyone else, tune in next week for episode 2, where we get to all kinds of questions. Man, we have questions coming from all around the globe. I love to see it. So keep those questions coming here at good old Options Bootcamp. Just hit us up, questions at the Options Insider, at Options on most of your social media platforms. Of course, your pro folks can use the live or the members hotline, however you want to get access to us. No shortage of ways for you guys and gals to get your questions answered here on the show. And Dan, if they have questions in between episodes of Options Bootcamp, they want to reach out to the sleepy one. Maybe they want to ask you about more illicit hand gestures. Where should they go? What should they do?
Well, I've got to have my developers block that sleepy dude comment. But yeah, we actually just had a listener hit us up in the chat room. What was that? Yesterday, the day before? It was Ollie John, as a matter of fact. We've been chatting.
Oh, your buddy from Germany. Yeah. Your tour guide from Germany.
Yeah. Seems like a real nice guy. So yeah, but you listener are welcomed also. You can just head on over to markettaker.com, 2 T's in a row. The second T is for
Theta.
Theta. Yeah, that's right. Theta.
Or is it for row? Is it for row? You're substituting row in now. Second T is for row. How confusing would that be?
Exactly. So yeah, make your way on over and hit me up. DM me in the chat room if you have a specific reason. You get it free for right now. I don't know how long it's going to go, but it's free now. So there you have it.
There you go. You can join Ollie John, the rest of his buddies over there at Market Taker. Don't forget the second T for Theta. That's going to do it for us on this episode today. For all you live cats hanging out, we'll be back instantaneously with your next episode. For everyone else, we'll see you back here next week, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.